Welcome to the Deep Dive. Today we're taking a close look at the recent earnings call for Saputo Inc., the big dairy player.
Yeah, exactly.
Our mission here is basically to unpack their Q4 and full fiscal year 2025 results. We want to get a handle on what management's thinking, their strategy, the challenges, and what they see coming for fiscal 26.
Right. We're aiming to cut through all the jargon, pull up the key numbers that really matter, understand the why behind them, and basically connect the dots for you.
Get that clear, concise picture.
That's the goal.
Okay, let's get straight into it then. Headline numbers for Q4 fiscal 25. What did they look like?
So top line, consolidated revenues hit $4.8 billion. That was actually up about 5% compared to the same time last year.
Okay, 5% revenue growth. What was behind that?
It was a few things working together. They mentioned higher selling prices domestically here in North America. Plus, international prices for cheese and dairy ingredients were higher. And importantly, they sold more volume up in Canada.
Got it. So revenue's up. How did that flow through to profit? Adjusted EBITDA was, what, $376 million?
Right, $376 million. And that was pretty much flat, similar to last year's Q4. Now, further down, reported net earnings was $74 million.
Okay.
But the number they adjusted net earnings, that came in at $128 million. And, well, this is the interesting bit, that $128 million was down quite a bit, 28% year over year.
Wow, 28% down on adjusted net earnings. Why such a big drop, especially when revenue was actually growing?
Yeah, they pointed to two main things. First, higher depreciation and amortization, D&A,
Right, from all the spending.
Exactly. It's directly linked to that huge capital investment program they've been running. As new stuff comes online, the cost gets spread out.
Makes sense.
And second, they had increased financial charges. That was mostly tied to using a credit line down in Argentina.
Argentina. Okay, that makes sense. Heavy investment means higher non-cash costs down the line. Now, thinking about the full year they just wrapped up, did they flag anything significant in the overall context?
Yeah, one thing they did highlight was the USA sector's performance over the entire fiscal year. Despite some of the headwinds we'll get into, their adjusted EBITDA for the full year in the U.S. actually jumped 18% year over year.
18% up for the full year in the U.S. That's interesting, given the Q4 pressure.
It really is. It suggests there's some, underlying strength there operationally, even if Q4 itself had specific issues.
Okay, let's definitely dive into the sectors then. Starting up north, Canada. How did that segment do?
Canada looked really strong. Revenue was almost $1.3 billion. That's up 6%. And adjusted EBITDA, a very healthy 14% increase, hitting $157 million.
14% EBITDA growth in Canada is pretty impressive. What drove that?
They credited a few things. Big operational efficiencies stuff like continuous improvement, supply chain tweaks, automation. They also had a better product mix, sold more stuff overall, and their G&A costs, general overhead were lower.
Right. And did they mention some specific customer wins too?
They did, yeah. Like providing mozzarella sticks for a big pizza chain's stuffed crust. Okay.
And also a protein coffee drink for a major QSR, a quick service restaurant chain. So real examples of getting things done commercially.
Nice. Okay, Canada sounds like a definite bright spot. Let's move south to the U.S. sector now. That's the biggest piece, right? Revenue was $2.1 billion.
Yeah, $2.1 billion, and that was up 11% year over year. The main thing pushing that revenue up was higher market prices, specifically cheese blocks, butter, other dairy ingredients.
Okay, higher prices driving revenue. But what about volume? Was that up too?
Actually, no. Volumes were slightly lower in the quarter compared to last year. They said this was mainly due to demand softening a bit, particularly in the food service channel.
Food service. So restaurants, cafeterias, that kind of thing.
Exactly.
So higher prices kind of mask slightly weaker underlying volumes. How did profitability look in the U.S. then?
Adjusted EBITDA was $148 million, which was up 7%. Management was pretty quick to point out the benefits from their capital investments.
Right, the cheese network stuff. Yeah, that network modernization. It gave them about a $27 million boost in Q4 alone. That plus other cost cuts and lower SG&A, selling, general, admin costs. That all helped the bottom line.
So the investments are starting to show up in cost savings.
Yeah.
But I remember they flagged some major headwinds too, didn't they?
Oh, absolutely. The big one was a $20 million negative hit from market factors. And that was mostly this thing called the negative milk cheese spread.
Right, the milk-cheese spread. Maybe quickly explain that for listeners who aren't as familiar.
Sure. Think of it simply as the gap between what they pay for their main raw material milk and the price they can sell the finished cheese for.
Okay.
When that spread goes negative, it means milk costs are high compared to cheese prices, and that really squeezes your profit margin.
Gotcha.
They did say they offset some of that negative impact through their pricing protocols, basically agreements to pass on some cost changes, and also favorable moves in the butter market helped a bit too.
So, tough commodity situation, but they managed some of it. They also mentioned duplicate costs in the U.S., right? From like running old and new plants at the same time.
Yeah, exactly. Those duplicate costs were around $10 million in Q4. But the key thing they noted is that number is trending down. That's directly related to their big network optimization plan.
Okay, important point. Let's shift gears now dramatically to the international sector. Revenue was $1 billion, but that was actually down 10%. What drove that?
Yeah, this is where Argentina really complicates things. The revenue number was hit hard by a huge non-cash negative adjustment, $225 million, all because of hyperinflation accounting.
Hyperinflation accounting.
Sure.
Okay, that sounds technical. Can you break down what that actually means and why it had such a massive impact?
It's definitely a complex accounting rule, yeah. It kicks in when a country has super high inflation. Companies basically have to adjust their financial statements for that country according to specific rules, IFRS standards. The main takeaway for listeners is that this $225 million hit is mostly non-cash. It's not cash walking out the door, but it makes the reported revenue and profit numbers look much worse on paper, especially when you compare year over year. It just distorts the picture.
Got it. So it's an accounting thing tied to inflation, makes the numbers look bad, but isn't necessarily a cash flow crisis. And this whole Argentina situation really slammed profitability too, right?
Oh, absolutely. Adjusted EBITDA for the international segment was only $47 million. That's a huge drop, $41 million down from the year before. And management was clear. Argentina was the main reason.
What specifically in Argentina?
Higher production costs, obviously, from inflation and the peso getting devalued. They also had issues with milk supply for a while, though they said that's recovering now. Plus, the weak peso hurt their U.S. dollar export sales. And on top of all that, the hyperinflation accounting itself had about a $9 million negative year-over-year impact directly on EBITDA.
Wow. Argentina sounds like a major headache. Within that international bucket, though, how did places like Australia and the UK do?
Australia actually did pretty well. They benefited from a better balance between what they paid for milk and the prices they got internationally for exports. Domestic sales were stable, but they really ramped up export volumes for cheese and butter, taking advantage of those good market conditions.
Okay, good news from Australia.
Hey,
UK.
the UK was described as, challenging, but they seem to have managed it okay. Volume was actually higher than last year, and margins are recovering. They also made a call to stop making functional ingredients there, which sounds like a cost-saving move.
And Europe got a separate mention in the Q&A session.
Yeah, they give some specific numbers. Revenue, $335 million. Adjusted EBITDA, $24 million. They flagged margin recovery there, driven by more retail sales volume and also selling off some old, high-cost inventory that was dragging things down last year. Management did sort of temper expectations, though, saying historical margins in Europe were really high, but they see a more normal level going forward in the low to mid-teens.
Okay, so it's a really mixed bag globally, isn't it? Canada strong, U.S. navigating but seeing investment benefits, Australia doing well, UK managing, but Argentina is a big drag, made worse by accounting rules. So with all that going on, what's the strategic focus for Saputo now?
Well, the CEO really highlighted what they achieved in his first year. Things like strengthening the leadership team, boosting efficiency, refining how they allocate capital, basically setting a clearer path to create shareholder value.
Right. And what are the sort of big strategic themes looking ahead?
A huge one is just continuing to realize the benefits from that massive capital investment program. They stress these investments are delivering real productivity gains.
Like the U.S. numbers.
Exactly. They specifically called out that $27 million benefit in the U.S. in Q4 and hitting the $100 million milestone for the full year from those U.S. projects. The investments are literally paying off.
Okay, so keep capturing those investment benefits. What else is key strategically?
They've got an SG&A optimization program going. Part of that was an admin restructuring in Q4 aimed at making the organization leaner. And they were clear, this is already helping performance now in Q1 of fiscal 26.
Leaner structure, seeing results already, and technology, AI.
Yep. Strategically adopting digital tech and AI. The idea is cost reduction, making decisions faster. They said the initial focus is really on the supply chain side of things.
Makes sense. What about growing the top line, the revenue side?
Focus there is on strengthening the customer value proposition, improving revenue growth management. And interestingly, they're speeding up entry into new priority regions. Think Southeast Asia, Japan, the Middle East.
Oh, interesting. Why now?
They mentioned it's partly driven by shifting trade and tariff situations globally. They did caution that becoming a credible supplier in these new places takes time. It's a multi-year thing, but they're doing it carefully so it doesn't hurt current profits.
Right. Strategic expansion. And what about their brands and innovation pipeline?
Investing meaningfully in core brands, that was the phrase, and a robust innovation pipeline, specifically targeting value-conscious consumers, which, makes a lot of sense right now.
Absolutely.
The name-check brands like Cathedral City and Clover is doing well.
And that huge network optimization project, especially in the U.S. cheese business, where are they with that?
Yeah, that's been a massive undertaking for about 4 years. Big investments aimed at building scale, enabling growth. They gave an update on the Franklin cut and wrap facility. Phase 1 is almost done.
And that's important because
they expect a meaningful drop in those duplicate costs we talked about as Franklin ramps up, especially once the Green Bay plant closes, which is scheduled for the end of this calendar year.
Okay.
They also just finished a big new distribution center in Wisconsin, which should help their logistics.
That network optimization really sounds like it's hitting a key point now. Yep. So linking this back to the challenges, how are these strategies helping them manage things like the milk cheese spread or the Argentina issues?
Well, on general macro volatility, they just said they're staying focused, aiming for consistency, and using their strong balance sheet, having financial flexibility for things like buying back shares. For commodity volatility, like that negative milk cheese spread, it's about disciplined cost control and leveraging those strategic initiatives to try and keep margins stable.
And Argentina.
Yeah.
That big drag.
The focus there now is on stability. They mentioned they're capitalizing on milk supply, recovering. It's tracking about 7% better in Q1 26 already.
Oh, that's good.
And they also think the gap between inflation and devaluation down there might narrow, which would be a positive thing, helping profitability and making things more predictable.
What about that softer demand in U.S. food service they saw in Q4?
They said they're working closely with those customers, offering value-added support, helping them with efficiency, menu ideas, improving profitability together. And encouragingly, they did say they're seeing signs of volume recovery in food service already in Q1.
Good sign. And the outlook for that milk cheese spread in the U.S., still negative.
Well, they feel they managed to partially offset it with pricing protocols and just better execution operationally and commercially. Looking ahead, they actually expect the spread to stabilize in the coming months or quarters.
Why is that?
Based on the overall supply-demand balance for berry in the U.S. and also how competitive U.S. exports are looking compared to, say, Europe or Oceania.
Okay. And tariffs.
Yeah.
You mentioned that driving some new market entries. Any big worries there?
They seem to think any direct impact will be limited, manageable. They feel their diversified supply chain operating in different places gives them some protection.
And the UK, still managing through challenges.
Yeah, basically continuing with discipline. They confirmed volume is up, margins are recovering as they exit that functional ingredients bit and focus on the core.
Okay, let's zoom out again to the overall financial health. Balance sheet, capital allocation, what's the picture?
They really hammered the point that they have a healthy balance sheet and strong cash flow. That gives them stability and flexibility. They flagged their net debt to adjusted EBITDA ratio 2.1 times at the end of March. They see that as a healthy position.
So with that financial strength, what are the priorities? Where's the money going?
Share buybacks were a very clear focus. They spent about $150 million on buybacks in fiscal 25.
Wow.
Yeah, $120 million of that was just in Q4. And they've already bought back another $63 million since the quarter ended. Management flat out said they expect to keep buying back shares actively.
Okay, buybacks are big. What else?
CapEx, capital expenditures, $113 million in Q4, right on plan, specifically targeted at driving productivity gains. They also mentioned dividends and paying down debt. But yeah, buybacks and those productivity investments really seem to be front and center.
And M&A. Buying other companies.
Seems like a lower priority for now. They'd rather focus on getting value from the investments they've already made and doing the buybacks. They mentioned current company valuations are part of that thinking too.
But not completely off the table.
No, they did say they're still looking at complementary opportunities. So the door's not shut, just maybe not the main focus right now.
Right. Okay, finally, let's talk outlook. Fiscal year 2026. The tone from management definitely felt, well, More confident, wouldn't you say?
It really did, yeah. A noticeably increased confidence in their ability to grow in FY26, even while admitting headwinds are still out there.
What's driving that confidence?
They believe it's the benefits from those big capital projects finally hitting the bottom line, their commercial strategy working, continued global demand for protein, and that sharpened focus on cost reduction we talked about.
And digging into the Q&A, what specifically did the CEO point to for that confidence boost?
He talked about their improved capabilities, their strong supply position, the diversity of their business, and especially seeing those big U.S. investments really starting to pay off now. They're planning for growth across all sectors, but seem particularly optimistic about North America, especially the U.S.
And Europe specifically. What's the outlook there?
Expecting margin recovery. Like we said, those historical highs, over 18%, probably aren't coming back, but they're aiming for a more sustainable low to mid-teens margin.
How?
More stability in costs and pricing, strong brands like Cathedral City and Clover, and those network optimization things, consolidating tut wrap, getting out of functional ingredients.
And stability in Argentina sounds key for the international segment.
Absolutely. They're seeing it. That milk supply recovery, tracking around 7% up in Q1, is a big deal. And the hope is that narrowing inflation to valuation gap acts as a positive catalyst, improving profits and making things less volatile down there.
Australia had that higher milk price they offered farmers. How are they dealing with that cost increase?
They expect to recover it, that roughly 6% increase. They plan to get it back through pricing, both domestically and in international markets. They sounded pretty confident it won't hurt their Australian bottom line.
Okay, let's circle back to those U.S. duplicate costs and savings. That seemed like a really big point on the call. What's the specific timeline and target there?
Right, so the duplicate costs actually peaked back in Q3 of fiscal 25. They improved in Q4, and they expect more improvement now in Q1 26. The really big drop, though, comes when the Green Bay facility closes end of this calendar year.
And the savings target?
They put a number on it. Roughly $200 million in operational efficiency and savings in the U.S. And crucially, they expect to deliver most, if not all of that, in fiscal year 26.
$200 million, mostly in FY26. That's huge.
It is, and they expect the duplicate costs themselves to be completely gone by fiscal 27.
Okay, what about D&A, depreciation, and amortization? With all these projects coming online, what should we expect?
Their modeling assumption for FY26 is around $628 million, give or take, maybe $620 to $630 million. That reflects all that past investment hitting the books, plus some currency effects.
And that change in the U.S. Class 3 milk formula. Any update on the benefit?
Yeah, they're still estimating it's worth $60 to $70 million US dollars annualized, based on their fiscal 24 mix. The new formula kicked in June 1st, but because of inventory lag, they expect that benefit to really start showing up in the results probably early in Q2 of fiscal 26.
Okay, a slight delay there. Lastly, those digital tech and AI projects, have they put a number on the potential benefits yet?
Not yet, no. Still early days, focused on the supply chain first, but they clearly view it as a, meaningful opportunity down the road for more productivity and a better cost structure. So, okay, let's try and wrap this all up. Saputo got through fiscal 25, navigated a lot of volatility, still grew revenue. They're definitely starting to see tangible benefits from those huge strategic investments, particularly in the U.S. cheese network. They've got clear plans, and they're showing early results in managing those tough headwinds of Argentina, the U.S. milk spreads.
And crucially, that outlook for FY26 sounds much more confident. It seems directly tied to finally cashing in on those years of investment, getting sharper on costs, and making smart commercial moves.
Yeah, exactly. And I think considering just how much they've invested, especially rebuilding that U.S. network, which is now really coming online, the big question for you, the listener, is how fast and how fully can they turn these operational gains and savings into real sustained margin growth? Especially when the market still has volatile costs and shifting consumer habits. That feels like the core challenge or the opportunity right there.
All right. Now, for our This Is Not Financial Advices segment, remember, this is purely based on the vibes, the commentary, the numbers from this specific earnings call. A wild, but, maybe plausible trade idea.
Okay, let's hear it.
The core idea is that Saputo's U.S. operational leverage, the payoff from fixing their network, hits faster and harder than the market currently expects. Management explicitly targets around $200 million in savings, mostly landing in FY26, with those annoying duplicate costs gone by FY27, all timed around the Green Bay closure and Franklin ramp-up.
Right, they're pretty specific on the timing and the amount.
Yeah. So the theoretical trade, go long Saputo. You're betting on a significant positive surprise in their core U.S. operating margins, really kicking in late fiscal 26 and showing fully in fiscal 27, driven by capturing those quantified savings and killing the duplicate costs.
Okay, makes sense based on their commentary. What's the hedge, or the other side of that theoretical trade?
Well, maybe you'd short a smaller, less integrated competitor, someone mainly exposed to the U.S. market, maybe more basic fluid milk or cheese, who doesn't have Saputo's scale, their diverse portfolio, or those explicit pricing mechanisms to handle things like the negative milk cheese spread.
So the argument is Saputo's investments and scale are creating a quantifiable advantage that widens the gap in a tough market.
Exactly. It's a pure play on that operational efficiency, finally delivering the big payoff they've been talking about for years. But seriously, remember, folks, this is just us talking, connecting dots from the call. It is absolutely not a recommendation. Do your own research.
Absolutely. Well, thanks for joining us for this deep dive into Saputo's latest quarter and outlook. Hopefully, it gives you a clearer picture.
Yeah, we've hit the key numbers, the sector breakdowns, their strategy, how they're handling challenges, the balance sheet, and that more confident forward look.
Keep these points handy as you think about the company. And of course, the full call transcript is always available if you want to dig even deeper yourself.
We really appreciate you tuning in.